The S&P 500 closed nearly 2% above its intraday low on Monday in its biggest bounce of its kind since February. Facebook was among the outperformers stateside after it announced a $9 billion share buyback. Plus, Deutsche Bank said the company had a, quote, extremely attractive valuation. Joining me now to take a look at some technical analysis is Serge Berger, head trader and investment strategist at thesteadytrader.com, and he's in Orlando, Florida. Serge, thanks for joining us. Let's start with the S&P. There seems to be some significant support just below where we are right now. Is that why we saw a small bounce in the shares on Monday?
Hey, Victoria, we might have. I mean, there's a lot of different factors here. I think one of the things that we still have to take into consideration is the potential, sort of demand here for buying stocks into year end. There's a lot of natural buy-side flow that's coming to the market right now. I think the bigger issue here, if we take a step back for a second, I drew some very simple lines here. You can see these two green parallels, if you will, and you've seen that we really overshot a couple of times quite notably, once in January, February of this year, and then again just recently in September. And all we're doing right now is kind of mean reverting back into this channel. And I really think that 2019 is going to, just like 2018, going to be challenging. I wouldn't be surprised if we have 10, 50% down at some point, and really getting us to the point where we retest maybe the 200-week moving average. That's the red moving average on the screen right now. More immediate term, I wouldn't be surprised if we're pretty close to actually bouncing into year end. We do have the Fed still on the table. But what we've seen so far is we've seen a lot of sell-offs that then give us an intraday bounce, but no follow-through over the next days or so. So that's really what I'm waiting for still. But I do think we're very, very close to putting in the lows for 2019, for 2018 at least, and then we'll see where we go for 2019. But I think 2,600 or so on the S&P is a pretty good level to watch.
Now, the tech sector has been having a bit of a hard time, the likes of the FANG stocks. Where do you think we go next for the tech-heavy Nasdaq?
Well, tech is a tale of a couple of aspects here. So first of all, we have to keep in mind that it's still the largest weighted part of the S&P 500. Was as high as almost 30% at some point earlier this year. It's now closer to 20%. Part of that is because there was a new sector being added, but it's still very, very heavy in the broader market. So I think 2019 is going to be challenging here. Growth rates are coming down. They're not bad companies, a lot of these Googles, Apples, and so on and so forth, but there's definitely a lot of challenges ahead. And I think as investors begin to realize, especially on the retail side as well, that they're not only exposed to these stocks way too much through their, say, mutual funds, which are, like I said, almost 20-30% of the S&P, they're also individually trading those stocks because those stocks have been working. So they're way overexposed to those. And as people start to de-lever and come out of those, I think it's going to be more and more choppiness ahead for 2019. For year end, I think here too we could see some seller exhaustion here pretty soon and get a bounce. But again, what we haven't seen yet, just like we haven't seen the S&P, is a real flush day, kind of like what we saw on Monday, December the 10th, and then followed by some sort of follow-through buying. So we're waiting for that, and once we see that, I think we could certainly get a bounce. 5% or so would not be out of the question.
So what about any key levels on the charts of the Nasdaq?
Well, I think if you look at the QQQ ETF, which is kind of the most heavily traded one that you want to look at here, this is I'm looking at a weekly chart. I think the lows here from really just the past few weeks in November, around 157, maybe as low as 155 or so, are probably pretty key. But again, they don't really matter that much until we see a real sell-off followed by follow-through buying. And so we've had a sell-off, seller exhaustion, but we need to see follow-through buying. So once we see that, then I think we can bounce. And you can see in the bigger picture on this chart here, I also drew these two green parallels. You can see the overshooting that this part of the market has done. So I think here too, ultimately in 2019, we have a lot more mean reversion to do. This is not crashing or anything. These are all good companies for the most part, but I think it's mean reversion is really more what's in order here.
Now, Apple is one stock that's particularly been taking a bruising. It's down about 27% from the recent peak. Do you think that creates an attractive buying opportunity for you?
Yeah, for sure. I think Apple's definitely getting much, much closer to be a buy rather than a sell. It has come down more than a lot of other things. Again, part of that is because it's such a heavily weighted stock and everyone knows about it. Everyone's got an iPhone in their pockets and so on and so forth. But it's definitely getting closer. So I think anywhere here in the high 160s is an area to look at for a trade. like I said before, I think for 2019, I wouldn't be surprised if we go lower. If you look at those two green lines, those two parallels that I drew here on this chart as well, you can see here the overshooting move. We're right back actually in the middle of this range right now. So I think in 2019, we might have more choppiness, maybe more downside. But for right now, anywhere in the high to mid 160s, I think is an interesting area to get a bounce towards 180, 190 or so into year end.
Serge, thank you so much for your time.
Thank you.
That was Serge Berger, head trader and investment strategist at thesteadytrader.com. I'm Victoria Scholar. Thanks for watching IGTV, and we'll see you very soon.